All right. Good morning, Traderfirstyear. This is the 3/26/2021 morning forecast. Markets are implying a move of 1.31% up down on the S&P 500. Markets have realized a move of 1.15% up and down. The difference between what market makers are implying and what has been realized has tightened. The spread decreased to 139 basis points. The put-call gamma imbalance has been reset following last week's triple witching, although I suspect we will return to an imbalance favoring calls. Option skew has been perpetually tilted towards short-dated calls on dip buying in the short to medium term. However, a tightening spread decreases left tail risk and the potential for delayed upside spikes in realized volatility. Realized volatility has increased recently above 18. This is favorable for wider and larger moves up or down on the index. I expect this to decrease over the second quarter during April, May, and June. This is favorable for traders looking to sell convexity into the market via short straddles and strangles on the indices and individual stocks. Bond market volatility is spilling over into other asset classes. The MOVE index, however, hovers around 65 to 68, or movement of 4 basis points daily in Treasury yields. However, economic growth, upgrades, and rising inflation expectations without rising inflation or economic growth are pushing up real yields, which is creating equity long duration valuation conflicts and raising discount rates. The S&P is expected to move close to 1.63% up or down this week, which means the S&P could rise 11% to 13% above its 200-day moving average, which is 3,494.41. The S&P bounced last week off its 50-day moving average, which was 3,840.7. Full-year S&P earnings are expected to total 174 per share. At current prices, this puts the S&P at 22 times earnings, which equates to an earnings yield of 4.5% and an inflation-adjusted earnings yield of 2.5%. Forecasters are rushing to upgrade nominal and real growth expectations for the full year in 2021. I will have a more full opinion of those forecasts on Monday's report. For the first quarter of 2021, the current estimates of nominal growth are 300 billion and real economic output of 130 billion. This forecast has been surpassed following the release of today's income report. The U.S. is on pace to generate a little under $500 billion of economic output in the first quarter. If this held through the full year, a pace would generate close to $3 trillion of economic output. I do not think this pace is sustainable or likely to culminate in those size gains. However, I do believe a gain of 1 trillion to 2 trillion in economic nominal output is possible in 2021. Full-year economic output estimates have increased following the passage of stimulus. The median forecast was anticipating close to $1.2 trillion in nominal growth and $800 billion in real economic output for 2021. Major fiscal stimulus is positioning the U.S. to capture more than one-third of global economic output in 2021. Economists continue to place the highest expectation for growth in the second quarter of 2021. Investment banking professionals are forecasting nominal growth of 400 billion and real output of 240 billion for the second quarter. This is a substantial amount of spending on goods and services which may fail to materialize if there are any delays in COVID vaccinations or rollouts. Under these assumptions, we would need $50 to $60 billion of spending on personal consumption expenditure in April, May, and June. I think these estimates are optimistic, and I continue to rely on more conservative estimates, but following the recent economic data reports, I am upgrading my forecast. I think we could see nominal growth in the second quarter of 700 billion to 600 billion. Real output is likely between 375 billion to 310 billion. From March, there is a strong possibility the $1,400 stimulus checks increase consumption similar to data in January of 2021, which recorded a $487 billion nominal gain in personal consumption expenditure. It is also equally likely to engender significantly higher personal savings rates, which may temporarily eclipse the 20% savings rate experienced early in 2020. I will have a full upgrade of my forecast following additional data releases. The February non-farm payrolls report was strong and robust. However, the trend has been weak non-farm payroll growth and elevated numbers of Americans receiving some form of unemployment assistance, which indicates large swath of slack in the labor market. Private forecast is anticipating payroll growth between 270,000 and 500,000 per month, which equates to 3.2 million and 6 million additional full-year U.S. payrolls. This key economic indicator is likely to pressure growth in the first half of 2021. However, the recent agreement on 1.9 trillion in deficit spending is a significant tailwind to nominal growth in the second half of 2021 and first half of 2022. This should increase aggregate demand, which should foster higher employment gains, but this assumes that virus cases come down substantially by April, May, and pandemic flare-ups lessen. Government stimulus checks total $380 billion, which represents a little less than 1/5 or 20% of the total bill. States and local governments will receive much-needed stimulus totaling $350 billion. This has led some market observers to anticipate economic overheating, which is favorable for upside risk in inflation. I believe these fears are statistically unfounded. However, I do not disagree with rising inflation as a potential risk in the short term. The recent increase in nominal Treasury yields and 5-year break-evens on TIPS, which are Treasury inflation-protected securities, towards 2.51% is transitory and likely reflecting recent increases in energy prices and base effects. The Federal Reserve typically subtracts 40 basis points from the break-even inflation rates, which would mean inflation expectations are currently anchored around the 2% inflation averaging metric. Following the passage of stimulus, larger fiscal disk savings increases capital inflows to finance very large twin deficits, which should put upward pressure on the US dollar and downward pressure on corporate and government bond yields. The current rise in yields and increase in growth expectations will likely favor a stronger US dollar in the first half of 2021. Potentially weaker inflation data than consensus estimates should allow real yields to remain negative. Dollar appreciation also dampens import commodity-driven inflation and should lessen temporary transitory base effects. Inflationistas and inflation fear mongers engaging in scare tactics are likely to be proven wrong. However, inflation base effects are expected to be short-term. There will be a transitory spike in headline inflation data from March, April, and May. The impact on core personal consumption expenditure is expected to be limited. Market expectations are split, but I expect the Federal Reserve will look through these spikes. Political risk have diminished in the first quarter due to reconciliation, but it has increased in the second half of 2021 and the first half of 2022, which may pose risk to much-needed investment spending, things like infrastructure, human capital, research and development. So I view it in the medium term as tilted to the upside due to potential gridlock. However, there is a possibility for another round of reconciliation in 2022 budget, which with the removal of the filibuster rules in the Senate, this could pave the way for easier passage of additional investment-led spending, which is much needed to raise the U.S. long-term potential growth rate. Although due to political isolation, this increases the potential for lone wolf domestic terrorism. Vaccine distribution is priced into Q3 2021, but distribution obstacles have increased and efficacy for herd immunity will be closely watched. Redefining herd immunity may become the norm. So instead of a fully vaccinated population of 90%, we may accept a different goalpost for full vaccination. Perhaps it drops between 70% to 75%. Details are currently unknown. The market is currently pricing in an additional 6.5% move up or down by June 18th. The S&P 500 could potentially trade as high as 4,163.29 and as low as 3,670.61 by June 18th. The VIX is expected to move 6.58%. The VIX is currently 19.70. The VIX price range is 20.99 to 18.43. The skew index is extremely elevated, which indicates market participants are paying up for catastrophic protection. Those are 2 sigma events. Stocks continue to offer investors the highest real returns. The nominal real yield on equities is 4.5%, while the nominal yield on 10-year treasuries is 1.63%. Real yields on all tenors of government bonds at the shorter end of the belly of the curve are decisively negative, but real yields at the longer tenors above 20 years have moved into positive territory. Real yields on U.S. equities remain strongly positive. Disclaimer: with realized volatility rising above 12, there is a larger risk of systematic, highly leveraged short vol strategies like equity vol targeting, trend following, and risk parity positioned for a sell-off and reduction in market exposure. The potential for a much larger delayed sell-off of 4 to 5% has diminished. We are much more likely to see a fall in realized and implied volatility and a gradual melt-up in asset prices. The April-May VIX contracts at 21 and 23 are fairly priced. In fact, they may now be overpriced given the new economic outlook. Passage of fiscal stimulus should juice the start of a new long-term economic cycle, which favors a continued fall in realized volatility. I am temporarily moving against a large rise in implied or realized volatility. However, I have been wrong before, but sell-offs will give investors great opportunities to buy the dip. Traders should focus on cyclical sectors which tend to outperform at the start of new economic cycles. For example, being long financials, industrials, metals, mining, oil, gas, consumer discretionary, and technology. Thank you for following. I hope you enjoyed this morning forecast.